All right. Happy Tuesday, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the last week in mortgage today, where we take you through the week that was in the mortgage industry. Each week, I try to pick some highly intelligent people from our lender member network across America to help me navigate the news headlines and the general business climate. This week, really pleased to have a couple great friends and longtime members and partners of the network with us. First, would like to introduce one of our co-hosts this week, off a recent promotion, the Senior Vice President, Mortgage Services, True Lion Federal Credit Union out of Winston-Salem, Beth Eller. Beth, good to see you.
Thank you. Glad to be here.
Like I said, you get a promotion in a year like this, you really got to be great. So congratulations. So
I appreciate that. I'm feeling a little boring. I look at your background compared to mine. I'm thinking, I'm kind of vanilla over here today.
it's hard to keep up with this madness back here. So yeah, but and also this week, really pleased to join into the co-pilot seat, the National Credit Union Manager and Vice President of Sales for MGIC, a longtime partner at TMC. Not only does he manage the TMC MGIC partnership, but also manages MGIC's relationships with CUNA Mutual and their credit union strategy and philosophy nationally. Good friend of the network, Chris Perry. Chris, great to see you.
Hey, Rich, thanks very much. Glad to be able to join.
Should be a great discussion, and let's go ahead and get into it. As always, any comments, questions, thoughts anyone has for myself, Beth, or Chris, don't be shy. Drop them in the chat, the Q&A, and we will go ahead and incorporate them into the show. So, Beth, some breaking news just before we went live here, 2 p.m. Eastern, Tuesday, for our podcast listeners. The FHA MMI fund just announced by HUD. It is at 11.1%. The national statute mandate 2%. They even went as far in the press releases to say they stress tested the FHA MMI fund under conditions. I think the quote was similar to the Great Recession. I think that analysis indicated that a 6.3%, well below the 11.1 new total, would be sufficient. So worst kept secret in the industry is that we're getting, an FHA MIP reduction, most likely in the next few weeks or at the beginning of next year. The rumors we've heard is it will be upfront and monthly. Now we understand why. Good work, good performance by FHA loans nationally, and some good news for lenders, partners, vendors, everybody to talk about as we get into the holiday season.
Absolutely. You look at that and I think it speaks to the underlying stability in that segment of the market. We talk a lot about first-time home buyers and struggles that they may be having, but you look at those numbers, it's pretty impressive really to see the year-over-year trend. They've had several years of increasing performance there. It's impressive.
It really is. Loans are performing well. I think I just saw the headline that mortgage delinquency is at an all-time record low right now. And Chris, obviously working for one of the just largest and premier mortgage insurance companies in America. This is kind of like, where you guys kind of leave off roughly, this FHA, there's certainly FHA borrowers above 660, but good news for the industry and just the performance of loans in general. There's got to be some challenges to MI right now, with a lot of payoffs and run up, but the loans you guys have on the books right now are performing so well. The performance of mortgages in America is at all-time high levels, which again, great news in a year where there hasn't been a ton of it.
Absolutely. PMI pricing is probably the lowest I've ever seen it in my 30-year career. It kind of goes in step that FHA would be reducing. And that's all great news for the consumer. Obviously, pending possible recession, we might be looking at a little bit different climate, but not projecting, anything significantly different than what we've been experiencing, which is really just fantastic performance.
Beth, obviously, it has not been a great year for the mortgage industry, but you're starting to see some things come into place now. Inflation and mortgage rates, we'll get to that in a second. We got a good inflation number last week, caused a little rally to mortgage rates. You've got now this news on the FHA premiums are going to be coming down almost for sure. We know that FHFA is going to be announcing lower delivery fees for affordable homes and upfront homes. Inventory's picked up a little. So you're starting to see the seedlings of a much more normal market and things that are going to really help affordability as we get into next year and beyond. Just need a little bit of help on the interest rate side. I mean, I'm at the point now where I feel like, 4.5%, 5%, which, even at the beginning of this year when we were still in the threes was, oh man, that's, it's higher than all the projections. And it feels like that would be a real healthy purchase market right now based on some other things coming together.
Oh, I think so, definitely. When you can get a couple points below where we are in interest right now, it really helps with housing affordability, without a doubt. And you look at the spreads between the Fed funds rate and where mortgage rates are right now, and it seems like there's room for compression there. I mean, I think the market's overcooked a little bit on rates as we all hope that they'll start to stabilize a little bit. And we had that good PPI number came out today as well, which, another indication that maybe things are starting to tick back down a little bit. It'd be nice to see a bit of a rally come out of all of that.
It's really interesting what's going on right now because we had a really good inflation number last week, the headline number, and the markets rallied like crazy into the weekend. And then what did you see first thing Monday morning? Lael Brainerd, the Fed vice chair. We may remember when Jay Powell was, up for renomination. There was a lot of talk about Lael Brainerd. She's been a longtime member of the Fed, potentially being that nominee as opposed to Powell. Powell ends up getting the nomination from the Biden administration, but she's the most senior, the most respected member of the Federal Reserve Board. And first thing Monday morning, she comes out basically with a statement that it's too soon to move to a slower pace of rate hikes. And, it probably will be appropriate to slow down, but maybe now is not the time. But to me, this is clearly just a coordinated effort, because the Fed, they need jobs to not be doing as well and consumer spending to tamp down.
Right.
So they're playing this game where they're out there trying to, scare the market away, which has worked largely. We see where mortgage bond rates are. And then when you get a good number, they're like, no, it really wasn't good. Keep banking. We need this to stick the landing. But it's just fascinating what's going on right now, isn't it?
Oh, they've got to put spin on it to get it to where they want to be. I mean, that 2% inflation target, is a long way from where we are right now. And continuing the hammer of 3/4% increases, it probably is really not enough to get there. They've got to get into the psyche of America, I think. What do you think, Chris?
I think there are just so many currents going back and forth with, what's happening with Fed raising rates. They've raised by 3.75 so far this year, with more next year. And are they going to be able to, execute a soft landing? And then, its impact on mortgage rates. I mean, you and I were talking earlier this week about, this has kind of created this opportunity for portfolio lenders to offer intermediate arms, and suddenly they're popular. And I'm curious, I know you've been able to offer some of them in the past. How has that helped you transition in the market?
Oh, yeah, there's certainly suddenly a lot of consumer interest in ARMs, which, you couldn't give away for the last 3 or 4 years. Who wanted an ARM when you could get a fixed rate in the 3% range? But suddenly interest in that, and also temporary buy downs are another thing you're starting to see out there, which is a bit gimmicky, but it sounds good on the surface. But yeah, we get solicited as a credit union. We're solicited multiple times a week now from third-party originators to see if we have capacity in our portfolio to take them on as clients. And we do have a third-party origination line of business. We also are very mindful, as a lot of people are right now, about liquidity positions and loan to deposit or loan to share ratios, and what that looks like. But if you've got a strong portfolio out there, there's plenty of appetite for ARMs that people will absolutely jump on.
That's part of the reason I wanted to have you guys on this week. It is fascinating what's going on right now. We hear from a lot of our depository members, especially the ones that aren't huge, like they're putting a lot of, to your point, Beth, like this was my world for many years working for banks. You always are managing liquidity risk and interest rate risk. ARMS helps
Mhm.
with interest rate risk because they adjust in the future as things adjust, but liquidity risk, tying up funds. A lot of our community bank and credit union members have said to me this year, like, man, we have like the coffer is full. Like we've done almost all our ARM production for the year. Any more on the books? I mean, I'm sure, you guys are probably, who knows what every situation is, but it's kind of interesting.
It's really interesting. I always think of loan to deposit ratios kind of like a seesaw. And, deposits go up too high, you need more loans. Loans go up, you need more deposits. And you're trying to kind of get to that place on the playground where you're both at balance, with loans and deposits kind of in a good spot. And it certainly has been a big swing from 2 years ago with all that physical stimulus, and help for the economy. Deposits were way up, so everybody was like, get all the loans you can. Now, most financial institutions across the board are saying, let's watch this loan growth and really monitor it. We don't want to outrun our deposits. It's a different environment.
And Chris, you have the unique perspective of covering credit unions all across America. And I know we've talked about this. I mean, like the independent mortgage bankers right now, they just have no outlet for ARM product whatsoever. There's just zero in the secondary market. Through our organization, this happens a lot, right? Because we're an organization of 275, like 60% are IMBs, 40% are depositories. People are always coming to me like, oh man, like get your depositories to buy all our ARM loans. I'm like, it's not quite that easy. Like they have limited capacity too in the form of liquidity risk, but definitely increased interest. And there definitely are some depositories, like Beth said, are doing some third-party stuff to complement their retail stuff, right, Chris?
Yeah, absolutely. It's been something that I've personally worked on over the last 7 or 8 years, helping credit unions in particular set up TPO operations. But strangely enough, this liquidity crunch has come along in the last just 2 months, and some of it are that the community banks and credit unions have run out, like their deposits are running off, and they've done so much lending. But I'm convinced there's a lot of them that still have a lot of liquidity. They're just nervous about, our interest rates going to continue going up, and that plays into their formula of net worth, and they're just nervous, right? So just kind of like where we are in the economy. We're in this period of transition, and nobody knows exactly what's going to happen.
Yeah, and good transition to, another topic and news story I wanted to hit on. KPMG, a very big investment firm, internationally, came out with the housing report from their housing analysts, basically saying, it was titled, "The Pandemic Housing Bubble is Bursting. U.S. home prices falling 15%. Looks conservative." Again, we went up 40% over 2 years. We've lost probably 5 in the last, nationally, the last 4 or 5 months. So I could maybe see that. I don't quite agree with that, but Chris, it speaks to the way depositories are forced to look at that. You put a 90% loan in the book, or even an 80% loan in the book with no MI, and home values go down 15%. Now you got a 95% no MI loan, and that makes it kind of tough.
Yeah, and we are semi seeing the same thing in terms of a lot of projections of 10-15%. I think performance is so strong, lack of inventory, the millennial generation, there'll still be a strong housing market. But yeah, it is going to be interesting to see, how much it falls, and will that be across the board, or will it be kind of like the way it went up, where there were some areas where it skyrocketed, which caused the average, to go up, but, not in all areas did it go up 40%. I wish it had gone up 40% in Virginia, where I live.
Well, what do you think about though, with the lack of inventory that we've got still? I mean, how much can home prices decline in some markets? That certainly larger markets where they really went up, okay, you're going to see some decline. But as long as there's this demand and lack of inventory, how do prices not stay fairly sticky?
Yeah. And how many people want to put their home up for sale right now when they're sitting on a 2.5 interest rate and sign up for a 7% rate for their new home? I think that's a factor too.
I can tell you right now, if 30-year fixed rates are between 4 and 6% for the next couple of years, there's no way home prices are going down 15%. There's too much
Yeah.
demand.
Yeah.
I mean, I operate from the school of common sense. It's just there's too much demand to buy housing out there, and we obviously need some help on the affordability issue. And that ultimately will decide everything. But if the Fed can stick the landing, we get to a more normal interest rate climate, as we get in the spring buying season, there's no way in hell home prices are going down 15% from here. I can't see it. Now, maybe I didn't read the whole report, but maybe it's based on interest rate projections of 8 or 9%. And probably should have done that research before, but my guess is it's not. So, but it'll be interesting to see how this all plays out. This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week joined by Truliant Federal Credit Union's Senior Vice President of Mortgage Services and MGIC's Vice President over Sales and their National Credit Union Manager, Chris Perry. And, I'd like to talk about the depository putting arms on the books thing because, to our IMB members, they could just put, it's not, that was my world for a lot. It's not that easy to just put loans on the books. And Chris made a good point as well. Not only are loan balances, and you mentioned loan to deposit ratio, Beth, a term any banker knows, it's your deposits versus your loans. And you get over 100%, you start to have to do a little regulatory dancing, but the loans are going on the books, the portfolio loans, that is. But deposits are also coming off at least nationally trending because people are still spending money into the face of inflation and credit card debt's going up and all that other stuff. So it's kind of like that double-edged sword and not quite as easy, right? To just start throwing 5-year arms on the books at 4.5%.
I think one of the interesting components is they almost, and Beth, you could give a perspective on this if you would. You almost have to start, keep lending at these interest rate now to balance out, the fixed rate loans that you may have put on the books 2 years ago at 3%, which are, really impacting the overall, finances of credit unions. So there's this conservative nature and many are scared. They also have a need to keep lending to kind of raise up that average interest rate. Beth, are you having those kind of conversations with your CFO at all?
Oh, absolutely. Absolutely. That's out there. And the other side is in trying to attract deposits. What do all financial institutions do? Credit unions in particular, you go out and you run a CD special. And so you're going to offer a really hot rate on a CD. Well, in order to be able to pay that interest rate, what do? You have to have a higher rate coming in on the loans you've got in order to cover the spread. So it does all connect together, and you have to manage all of that really, really well. To make sure that you don't get real out of whack in your concentrations or those deposits. And the depository runoff was something you read a lot about if you go out there. All institutions are seeing people spend money. It's part of the inflationary effect, and it's going to continue that way. So you've got to attract deposits at the same time while you grow your loan growth. And so your interest rate mix there has got to be compatible. You need a higher rate on the loan and you need a higher rate on the deposit payout. So you kind of got to incrementally step it out there. But it's a big conversation to have. Most financial institutions right now are not looking for really robust loan growth. They want loan growth, and we certainly don't want this huge slowdown, but you've got to really watch that with a recession looming potentially, where people are going to spend down their savings. So you've got less money on deposit. You need to make sure your loans match that kind of run.
It's a great point. If we do go into the dreaded R word, that always causes deposit levels to drop as people pull out money to pay for things, and would exacerbate the problem. But excellent perspective from both of you, Chris and Beth, on a topic that we've talked about all year on the show, but we've never really gotten to that level of detail. So I appreciate your perspective on that. Got a good question in the chat from our friend Stan Foraker. Beth's comment about consumer psyche is interesting. What are her thoughts about how we as lenders can help mitigate the negative financial news communicated by the media? Or is it just a waiting game until consumers decide rates are not coming down anytime soon? Great question, Beth. Good luck with that one.
Well, if I knew the real answer to it, I'd be on a beach somewhere with a coconut drink in my hand, I think is what I'd say. But wouldn't we love to be able to mitigate the negative media news on every topic, not just on financials? I do think that you have to look for the high points, like the FHA news today. You have to look for things within your institution or your lending business that you can point out to people and try to market out there that is positive, whatever that may be, whether it's a new product line that you've opened up, whether it's a new way to look at using MI, maybe you offset some of your risk with putting MI on loans. How about the conforming loan limits that are getting ready to go up? That's really, you start getting in the 700,000 range for a lot of the country. That's a jumbo loan amount all day long. So I don't have a silver arrow for that. I wish I did, or a crystal ball, but I think the best way to hit it is just kind of go the other direction and not buy into the negativity.
Chris, any thoughts on Stan's question? How we as mortgage lending professionals can help, overcome the consumer psyche and all these negative headlines we've been forced to endure all year?
I think it's really just the same playbook that's been in effect for my whole career. Be a consultative, loan officer and seek to educate, to educate home buyers, first-time home buyers. I mean, when a millennial goes to buy their first home now, if they weren't looking a year ago, they don't know necessarily that, the mortgage they would have gotten a year ago was so much less than they're getting today. They're just looking at it as, well, these are the rates, this is the, and these are the options. And so I think if the loan officers are really doing their job and going through trying to figure out the best loan programs for their borrowers, that will overcome any trepidation that they may have.
Great advice. I would only add, and you guys both kind of touched on this, content. Like if you are a mortgage professional, take out the big media middleman and produce your own content for your customers and your past customers. Honestly, that's why we created this show, honestly, is to give everybody a 30-minute snapshot of what the hell is going on in the mortgage industry. Y'all get bogged down in your own silos. We'd like to hope and think that this is providing some value to people. So that'll be my advice. If you're out there, get out there and create a daily email newsletter or some sort of video communication to people you want to communicate to tell them what's really going on, right? Because this industry cracks me up. I host this show and the one with Charisma on Friday, so I'm constantly just combing the headlines, which have been like enough to make you just drink daily this year, honestly, because they're so sensationalistic. And also in this industry, the headlines are always from like a week ago. Like I've had the biggest rally in a decade in rates. Now, it was again from a deep, dark place, but and we're still getting the news stories from last week about how rates have risen to the pre CPI numbers. But this is an industry where the headlines, they helped us a little bit during the pandemic because rates were low and all that. And so you gotta be even-handed, but hasn't done our industry any favors this year, Beth, right?
Not at all. No, not at all. And to your point earlier, Rich, that the Fed has one thing in mind, and that's slow the economy down. Slow the economy down. I was out shopping on Saturday, like a lot of people were, for early holiday shopping, and the stores were full. Lines were 5-10 people deep, and I was sitting there thinking to myself, "Whew, the message hadn't hit home at that level yet." So I feel like it's starting to cool us all off a lot, but it's going to take a while to get it all the way down.
Chris, the pandemic has changed so much in America. One thing I believe is just like Americans like spending money on things because it became so, oh man, I could have Taco Bell at my door in 40 minutes, like delivered to me, or Amazon delivers to my house same day, 4 p.m. And it's just, I need this, I need that. And my girlfriend yells at me all the time for overpaying for things on Amazon out of convenience that you could, but I feel like it has really changed Americans' thoughts on spending, and the evidence right now is Americans are just blindly still spending into the face of inflation. It really defies things we've seen in past cycles of high inflation. Chris, any thoughts on my philosophy that Americans have turned into drunken spenders because of the pandemic?
I mean, these are personal thoughts, but I travel a lot. The airplanes are full, the airports are full. Restaurants seem to be doing well, even though they're charging twice as much as they were 2 years ago. But, I often kind of think to myself, being fortunate and having been able to work for a company like MGIC for 22 years, I don't really, whether I pay $6 for a gallon of milk or $10 or $3, it's not that big of a deal for me. But boy, I think half of our society is they're up against it, right? And they're living paycheck to paycheck. So I think we kind of have a bifurcated situation. But yeah, I still, I feel like that if you've got a strong job, you're in the market to purchase things. And that's going to flow over when things calm down a little bit to a good purchase market next year.
It's going to be a fascinating case study that is studied by our kids' kids and, kids in this country and internationally for centuries. The impact financially and socially of this global pandemic that we've all gone through, and some of the things that changed because of one of the things I just believe is just it also changed Americans' relationship with their home. And made the home and where they live much more important to them. Part of that was forced. You got, a third of America working from home, at least.
Couldn't leave.
So there's that part of it. All right, I'm home more. My home has more meaning. But then just, it's everything that's happened with housing in the last couple of years, Beth. But that's part of my belief that I don't buy into this, we're going to lose all this appreciation from the last couple of years, and we're going to have some big housing, bubble bursting. I just don't see it because, again, there's too much demand. Now, if rates are 10%, it won't matter.
I totally agree with you. I know in some ways we have self-created inflation. You pump $5.5 trillion into the economy. What do you expect? And not that it wasn't needed. I'm not making that kind of a statement, but that's why we've got inflation right now. Basically, people are all chasing after the things they want. They want their homes to be more comfortable. They're doing home improvements. They're buying those things that they can find. We still have supply chain constriction. And I think once that starts to really smooth out, then it starts to level out a lot of this stuff. So there is a waiting game to it all. And the inventory issue was there pre-pandemic. It's just worse now. The fact of the matter is you've got the big conglomerates who've bought up all your first-time home buyer, like entry-level homes. We've got to deal with that somehow. They're now converted to rentals. And then you also have, builders who can't build houses fast enough and can't make them profitable in those starter home market ranges. I think that's a huge problem that we're going to have to figure out how to address.
A lot at stake for housing and how it relates to the broader economy. Chris, sorry, you're about to talk there.
Yeah, I was just going to throw out. I was listening to a program the other day on Ford Motors, and they were talking about when they entered the 20s, and they made this point that there was this big pandemic back in the early 20s. I think it was 1920, and people were like just couldn't do anything, couldn't spend money, wouldn't go out. And it resulted in the roaring 20s that just boom, economic boom for 7 or 8 years. Of course, it was followed up by the Depression, but, let's hope that doesn't happen. But I think it's, there is just going to be still a lot of enthusiasm carrying forward for the next couple of years, just kind of release, getting away from the pandemic.
Be interesting to see how it all plays out. We'll be talking about it here every Tuesday at 2 p.m. Eastern, as we have here on the last week in Mortgage Today. And Chris, we want to really thank you for coming on the show, but more importantly, want to really thank you for just the partnership between MGIC and TMC has been such a great one. Your role in leading and managing that relationship, and just all the great synergy connections that you've kind of connected us with our great credit union members and some of your credit union clients at MGIC. Really, really appreciate you guys, the partnership and your insight and expertise on this week's show.
Thank you. Absolutely. The feeling is mutual. We've really enjoyed the partnership and sponsorship and, great events and shows like this, and very enthusiastically looking forward to next year and more of the same.
San Diego and Nashville in March and September. So a couple of good locations. And of course, our 12 days of TMC event that we have coming up in less than 2 weeks, which is going to be incredible this year. We've got 12 amazing keynotes to kick off each of the 12 days and incredible sessions. And it's just $395 to sign up your whole company for many, many sessions over the course of 3 weeks that really are meant to enrich and to bolster and make lenders more powerful and sharper and smarter as we go into the new year. So Beth Eller, Trueline Federal Credit Union, thank you so much once again for co-hosting the show this week. Really, really appreciated your insight and expertise, especially on the portfolio lending issue, which again, we've talked about all year, and you and Chris did a great job giving the full context around that.
Thank you, Rich. Always glad to be a part of TMC. Y'all are awesome.
Awesome. We got to cue this trio up again for this show. This was fun, and appreciate you guys. Appreciate our audience. We're here every Tuesday at 2 p.m. Eastern. You also can find us on YouTube. And of course, wherever you get your podcast by searching TMC Connect. So until next Tuesday, have a great rest of the week, everyone. Take care, Chris. Take care, Beth.
Thanks, everybody.
Bye.